U.S. stocks have defied skeptics and rallied so far this year. One explanation may be that things are not as bad as they seem. In fact, according to a Bloomberg Intelligence model, the worst of the economic pain may have happened months ago. The index shown here analyzes monthly changes in key inputs that factor into a recession, including capacity utilization, jobless claims, manufacturing, and sentiment. The index indicates that an economic downturn possibly started in June and bottomed in December, while the model still signals weakness in the economy. As long as it stays above its late 2022 lows, the outlook is favorable for the S&P 500. In the 8 recessions since 1970, the S&P 500 returned 8.9% on average over the 3 months after BI's model hit its low, and 20% over the 12 months after that. Right now, equities are up by about 8% this year, and confidence is growing that the Federal Reserve will soon end the cycle of interest rate hikes. Some say that a bull market in stocks is already happening. But not everyone sees it that way, with investors pulling cash from equity mutual funds and exchange-traded funds in 11 of this year's first 15 weeks. Others are expecting a tsunami of disappointing earnings and guidance. However, following week 1 of the corporate results, it's been a blowout. 90% of companies beat on earnings per share, 73% on sales, and 67% on both. This is well above last quarter and historical averages. But remember, this is due mostly to big banks, so wait and see. My opinion is that the bottoming process will take time, and perhaps the best strategy is to average in over time. But there is no guarantee, and the risk is all yours. ChewDog out.